Sunday night, 10 p.m. Eastern. Marcus opens his charts, sees Eurodollar drifting, and jumps in. 2 hours later, he is down 3%, staring at a chart that barely moved, but still stopped him out twice. He did nothing wrong with his entry. He picked the wrong day and the wrong hour. That single mistake, trading blind to time, is what we are fixing today, one clock and one calendar at a time. Here is what Marcus did not know. Sunday evening in New York is still Monday morning in Asia, and most of the big banks and funds are not even at their desks yet. Volume is thin, so the same size order that barely nudges price on a Tuesday can shove price around like a pinball on a Sunday. Spreads widen, stops get tagged on moves that reverse minutes later, and the candles look busy but go nowhere. That is not volatility working for you. That is a market with almost nobody in the room. So if Sunday is the trap, the real question is this: when does the market actually fill up with players? And why does that matter more than the pattern on your screen? Think of volatility as simply how far price is willing to travel in a day. A quiet day might give Eurodollar 40 pips of total range. A busy day might give it 120. Every one of your setups, entries, stops, targets needs room to develop, and room only exists when the market is actually moving. More range means more legitimate chances for price to reach your target before it reaches your stop. Less range means you are fighting for scraps and getting chopped by spread. So opportunity is not random, it tracks volatility almost perfectly, which raises the obvious next problem. How do you actually know, before you risk $1, which days and which pairs are going to move? This is where a volatility tool earns its spot in your routine. You feed it a pair, say Eurodollar, and it pulls years of historical daily ranges and shows you the average move, in pips or in percent, broken down by day of the week. You are not guessing anymore. You can see, in black and white, that Tuesday, Wednesday, and Thursday consistently print wider ranges than Monday or Friday for almost every major pair. That single chart turns trading from a hunch into a plan. But a wide day does not mean the whole day is wide. Inside that day, there are hours that do all the heavy lifting, and hours that do almost nothing. So which hours are we actually talking about? Before I show you, pause for a second and guess. Which two trading sessions overlapping create the single busiest window in all of Forex? Got a guess? Here it is, London and New York overlapping, roughly 8 a.m. to noon Eastern. During that stretch, European banks and American banks are both fully active at the same time, and Europe is the busiest session on the planet for currency trading, simply because it handles the largest share of daily volume. Add in scheduled news releases, central bank decisions, jobs numbers, and you get short bursts where the normal rules of range get suspended entirely. This overlap window is where most of the week's real range gets built, and that range does not land evenly across the week. Zoom out to the full week, and a shape appears. Monday is still waking up, as Asia and Europe get back into rhythm. Tuesday, Wednesday, and Thursday are the meat of the week, full participation, most of the scheduled news, widest pip ranges by a noticeable margin. Then Friday starts strong through the London and New York overlap, but once you cross roughly noon Eastern, liquidity starts draining fast as desks book profits and head into the weekend. Trading Friday afternoon is trading a half day dressed up as a full one. And the part that actually saves your account is coming right after this, because knowing the best hours only helps you if you also know, cold, which hours to simply refuse to trade. 3 specific windows deserve a hard no from you. Sunday evening, for the thin liquidity reasons we already covered. Late Friday U.S. session after that noon Eastern cutoff, where spreads widen and moves stop meaning anything. And major scheduled news releases themselves the 60 seconds around a big number, because that is not trending, that is a coin flip with extra zeros, prone to violent whipsaws that stop out both sides of a trade in minutes. None of these are about a bad pattern forming. They are about bad context, meaning where you are on the clock, and the calendar matters more than any shape your candles make. Let's actually hunt for this, live, on Eurodollar right now. First move is not to stare at candle shapes, it is to check the clock. Are we inside the London-New York overlap? Second, look at candle size over the last hour compared to the last few days. Are ranges expanding or still asleep? Third, has a scheduled release just printed? And if so, give it a few minutes to settle before trusting the direction. Only once time and range agree do you start looking for an actual setup to trade. This is context first, pattern second, every single time, and once time and range line up, here is exactly what a tradable moment inside that window can look like. Say price shoves higher right as the overlap opens, then pulls back into a tight little flag for a few candles. Classify it out loud before you touch it. This is a simple pattern, bullish in direction, and a continuation type. It is betting the original push keeps going, not reversing. Your entry trigger is a break above the flag's high. Your stop sits just under the flag's low, with a little wiggle room so normal noise does not tag you early. Your target is set by risk to reward. If your risk is 20 pips, you are looking for at least 40, a 2-to-1, before you even place the trade. And say this to yourself every time. The pattern can absolutely fail. Price can break the flag and reverse straight into your face. The stop is not a suggestion. The stop is the entire reason you get to trade again tomorrow. Nobody, and I mean nobody, trades every session back-to-back without their decision-making falling apart. You need sleep, you need a life away from the screen, and you need a written schedule that says exactly which hours you are at the desk and which hours you are not. Pick your window. For most retail traders, that is some slice of the London-New York overlap, and protect it like an appointment. Outside that window, you are off duty, on purpose. But what happens if your day job or your time zone makes even that overlap impossible to sit through, live, every single day? This is the thing this whole video was actually building to. You do not have to be glued to the overlap to trade Forex well. Swing trading holds a position for a few days, checking in once or maybe twice a day, so you catch the midweek range without living inside it minute by minute. Position trading stretches that even further, holding for weeks, riding the bigger structural moves and barely touching the chart during the day. Both styles still respect everything you just learned. They simply zoom the calendar out instead of the clock. The tool is the same. The schedule is just built for your life instead of a trading floor's. Let's lock this in. Tuesday through Thursday carries the widest ranges of the week. Friday is a real trading day only until roughly noon Eastern. Then it turns into a half day. Sunday evening, late Friday, and the minute around major news are all times to watch, not trade. In whatever style you pick, day trading the overlap, swing trading the week, or position trading the month, build it around a schedule you can actually keep. Write this one down. Amateurs count pips. Professionals count risk. And both of them live and die by the clock they chose to trade. Marcus, from the top of this video, moved his sessions to the London-New York overlap and cut his Sunday habit completely. Same skill, better hours, calmer account. Tell me in the comments which pair you are building your own schedule around. Next up, we take that schedule and put actual risk numbers behind it so every trade you take has a size that fits your account, not just your gut.